As we noted in our analysis a month ago, market prices in the last half of August were extremely negative after what had been a relatively strong July. September, frankly, didn't offer any support. The October lean hogs futures contract set a new lifetime low last week and lost 10% during a month capped by another large inventory report. The USDA's latest quarterly numbers showed the highest total on record for the month and more pork on the way. We talked with Lee Tuesday afternoon and began by asking for his thoughts on September's estimates.
Not too many surprises in the current report. Actually, pre-report expectations, if you take the average of all analysts, peg the numbers, the headline numbers exactly. So looking at the all hogs and pigs, the breeding herd, and the market hog inventory. So I think when you look at not much market reaction as we were very much in line with pre-report expectations. You know, if there was a little bit of surprise, I think it's when you break down the market hog categories. The 120 pound, 179 pound, 180 pound and over, those were larger than pre-report expectations, up about 3.9%. Could suggest maybe slaughter a little bit larger as we get into October and November than anticipated, but overall markets didn't react much to it.
So beyond that time frame, is there any sign that producers are going to start to slow down?
I think what we're looking at is very much a measured, calculated expansion, breeding herd up about 1.2%, realizing that we'll get a little bit additional growth when we look at productivity. Pig saved per litter was up 0.7%, a little bit lower than what we've seen in the past, so the 1.5%. But we've really seen the market grow as the infrastructure, as the facilities have allowed us to, and the demand situations has allowed this growth to really support profitable prices.
Well, has 2017 been profitable so far enough this year that the entire year will be overall?
It has, and that even includes a return to, I think, red ink as we get into fourth quarter. First quarter of 2017, we're about a $12 profit per head. Second quarter was about $17 profit per head. Third quarter, $21, and then a return to red ink, about $5 loss here in the fourth quarter. So that would average us about $11 profit per head for farrow to finish production. As we get into 2018, it looks to be about $8 profit per head with profitable margins in the first three quarters, and then return to red ink around that $9 to $10 range in the fourth quarter.
Can you explain what impact lower feed prices and the possibility for lower feed prices into next year provides?
They've helped, but I think what we've seen in price changes has very much overshadowed any of the impact on feed costs. If you look at the first 7 months of 2017, we've seen about $61 per hundredweight on a carcass basis for farrow to finish, total cost of production. Lower corn costs, I think that's going to reduce it to about $60 per hundredweight, so about a $1 decline in that total production cost. But looking at prices have declined about $14 or so as we're projecting for the fourth quarter. So very much overshadowed by the lower prices than the decreased cost of production.
Well, when we last talked in July, I think you said that the fourth quarter you thought we might see some bearishness. Explain how we've fallen and why.
And fallen we have. We've seen highest prices of 2017 was the third week of July. 88.48 was the highest price in Iowa, southern Minnesota. Over the last 10 weeks, we've dropped about $3 to $4 per week, and that's put us in about $54.61 per hundredweight, so that's about $34 lower. I think we have maybe started to level out a bit as the futures do suggest.
Do you think that will last into 2018, that leveled out, or at what point do you think we can start to climb higher?
I think we have the potential to see a bit higher prices into 2018. The reason I say that is futures markets right now are reflecting that, about a $2 higher price on average in 2018 than 2017. When we look at the fourth quarter here in 2017, I think we're in that $55 to $59 range. We get in the first quarter of 2018, 62 to 66. Second quarter, we're looking at about 71 to 75. Third quarter, 70 to 74, and then back down 57 to 61 for the fourth quarter of 2018.
Finally, Lee, can you describe what effect new pork production facilities opening up has provided for the industry, either locally or nationally?
So I think there's two ways to really look at this added capacity that we've seen in the industry. First and foremost, it really has helped mitigate that pent-up demand that we had for additional shackle space. As we got into the fourth quarter of the year, the last several years, we were at, near, or above that theoretical capacity, and that really precipitously drove down prices. We are in a much better situation here in 2017 than we were in 2016. So that's going to help prices in this fourth quarter much more for producers than we've seen in the past. It gives them a bit more leverage as packers are after hogs. Once these packing plants get fully operational, they will be chasing hogs to fill those plants, to spread those fixed costs over as many hogs as they can. Secondly, it does give the industry the opportunity to grow. But just because we've added packing plants doesn't mean we will grow. Profitability is going to drive that growth. And we've seen profitability, really, if you go back the last 52 months, 42 of those months have been profitable from a farrow to finish standpoint. 2018 looks to be profitable on an annual basis. So the incentives in the industry are for expansion, but again, at that calculated, measured level of expansion.